Welcome everyone to this special info session on Lead Lag Study. My name is Marc-Antoine Fleury and I will guide you through this session. Lead Lag Study is important for your utility because this is how you will calculate your working cash allowance. In today's session, we have three items. First, we discuss why you need a lead lag study. Then we go on to discuss what is a lead lag study. And finally, we tell you how we can help you with conducting a lead lag study. So why do you need one? In the last filing requirements published in June of last year, the board stated, and I quote, 2012 will be the final year for which the 15% allowance approach will be allowed as a default value. And the board also said that it was only reviewing the possibility of requiring lead lag study. What this tells us is that LDCs will have to use lead lag studies. But what is a lead lag study? A lead lag study is attempting to measure the actual time between a utility's out-of-pocket expenses and the collection of revenues from those services. Basically, what the lead lag study does is it looks at two time periods. The first one is the time between customer receives service and the date the utility receives payments. That's called the revenue lag. We call it lag because you provide a service first and then you get paid for it. The second period is expense leads. This is when you receive services and goods and the time you take to pay for them. So there's an actual lead because you receive the services and then you pay for them later. But how is lead lag computed? Step one is what the lead lag study will provide you. With the revenue lag and the expense lead, one less the other, you basically get a lead lag in days. This divided by the number of days in the period, most likely 365 days, will give you a percentage of lead lag. That percentage is basically the amount of time you have to sustain your operations with your own funds. So that's the whole purpose of the lead lag and the working cash allowance is how much money do you need to sustain your own operation before you get paid for it. In step two, we take the percentage of lead lag, we multiply it by the actual cash expense, most likely most of your OM&A and also cost of power, and this will give you the working cash in dollars. This is the amount that goes into the rate base and where you earn a return. Here we have an example of the working capital requirement for Hydro Ottawa. During this session, we will use a number of tables that are all taken from the latest cost of service application by Hydro Ottawa. So quickly, you have the cash items, cost of power, OM&A, and other items. Then you have the revenue lag, which is all the same. The reason why it's all the same is because as a utility, you provide a bundle service to your customers. So basically, the cost of powers, the OM&A, and the other items are all provided on the on the same basis, and you get paid for them at the same time. So that's why the revenue lag is the same. On the expense lead, there is a different payment for each of these items. That's why there's a difference between the different leads between the budget items. The two together, so the revenue lag less the expense lead, give you a net lag. And this divided by 365 days, or the number of days in the period. For example, if you take a month of February with 29 days, well, you're actually going to have 366 days. So the net lag divided by the number of days in the period will give you a percentage. This is basically step one, column from A to D. Then for step two, we take the same percentage, we apply it to the actual cash expense, the total cash expense, and this gives us the working capital requirement. Once all the capital requirements are added, you get your total working cash requirement, And this divided by the total cash expense will give you a lead lag in percentage that we'll use for the forward test year, which we'll get to later. But how do you do a lead lag study? Before we get into the revenue lag and expense lead, there's a number of first steps you need to do. The first one is to define the study period. It has to be 12 continuous months, but there's no need for it to match the actual fiscal year. The reason is you're looking at cash expenses, so there's no need to match the audited financial results. Your accounting system should be able to provide you with all the cash transaction within the study period. You also need the average number of customers, and this should be based on the reporting and record keeping requirements from the board because since it's a filing, the board will want to match the numbers in the lead lag study with anything you've filed previously. That's why it's important for you to track the triple R filings with respect to the average number of customers. You also need the sales to those customers also for the period. Once you get all of your data, it's important for you to see if there's any changes in the business environment. The reason is the lead lag study will be based on historical values, but it will be used on a forward test year, on a forecast year. So if there's any changes going forward, or if the forecast year looks like very different from the past, it's important for you to track any changes that could have an impact on the actual cash transaction of your utility. A good example would be if you're planning to switch your residential customers from bi-monthly billing to monthly billing. This would have a dramatic impact on the actual service lags, which we cover later.